As we go live just before the opening bell on this Tuesday, November 11th, Strive Inc., trading under the ticker ASST, is painting a concerning picture in the pre-market. The stock is currently indicating an open at 1.44 per share, which is a drop of 4 cents, or about 2.7% from yesterday's closing price of 1.48. Now, the common expectation when you see a stock dipping like this before the market even opens is that some negative catalyst has hit the wires, perhaps a downgrade or a missed target. But the reality for ASST is infinitely more complex and, frankly, far more interesting than that. This pre-market dip isn't about a simple press release. It's the market's attempt to digest a massive, high-stakes financial maneuver that Strive's management team just completed yesterday. This is a story of leverage, aggressive strategy, and a company that has fundamentally tied its fate to the future of cryptocurrency. What many investors are just waking up to is that Strive yesterday officially closed its upsized initial public offering of a brand new class of shares, a variable rate Series A perpetual preferred stock. This new security trades under its own ticker, SATA. Strive successfully raised $160 million from this offering, selling 2 million shares at $80 apiece. The crucial detail here, and this is the entire point of the strategy, is that this maneuver was designed to acquire more Bitcoin without diluting the existing common shareholders, the ASST holders. This is what the company calls its Bitcoin amplification toggle. They're pulling a lever to increase their Bitcoin holdings and, by extension, the Bitcoin exposure for every ASST shareholder without printing more ASST shares to do it. And they immediately put that capital to work, announcing the purchase of 1,567 Bitcoin at an average price of around $103,315 apiece. This brings their total corporate treasury to 7,525 Bitcoin. This is the reality behind that 2.7% drop. The market is trying to calculate the true cost and benefit of this new $160 million liability, which comes with a hefty 12% annual dividend, against the benefit of holding 1,567 more Bitcoin. To understand Strive, you have to understand its two-part business model, which is unique. On one hand, Strive Asset Management is a legitimate, large-scale asset manager, a registered investment advisor with over $2 billion in assets under management. It offers ETFs, 401k plans, and direct indexing, all built around a shareholders first philosophy that often involves shareholder rights-focused proxy voting. This is the more traditional side of the business. But the parent company, Strive Inc., is something else entirely. It has declared itself the first publicly traded asset management Bitcoin treasury company. Its stated mission is to increase its Bitcoin per share and to use Bitcoin as the hurdle rate for all of its capital decisions. This means the 1.44 price you see this morning is not just a reflection of its asset management business. It is a direct, high-octane proxy for the price of Bitcoin, supercharged by this new layer of corporate leverage. The stock has an astronomical beta of 17.4, meaning its volatility is extreme. This is evidenced by its recent performance. While the stock is up over 200% year-to-date, it has fallen 42% in just the last 30 days. This is not a stock for the faint of heart. It is a battleground. This brings us to the financial health under the hood, and this is where the reality check gets harsh and where the short seller thesis builds its foundation. Strive is not profitable. The company has reported negative earnings per share and negative EBITDA. Its revenue growth is impressive, at over 111%, but it's not enough to turn a profit yet. More concerning for financial traditionalists is its book value. The company has a negative price-to-book ratio of negative 16.3. In simple terms, this means the company has negative shareholder equity, a result of cumulative losses over time. And now, management has just added a significant new financial obligation. That SATA preferred stock, which raised $160 million, comes with a 12% annual dividend. That is a $19.2 million annual cash payment that Strive is now on the hook for. The critical question the market is asking is, if the asset management business isn't profitable, where does that $19.2 million come from? The company is making a bold bet that the appreciation of its 7,525 Bitcoin will more than cover this cost, but it is a bet that relies entirely on an upward-moving crypto market. This is why Strive Inc. has become a prime target for short sellers. The data is staggering. As of the most recent reports, a massive 38.58% of the stock's entire free float is sold short. This is an enormous, concentrated bet that the company's common stock, ASST, is heading lower. The short thesis is clear and compelling. They see a company with negative book value, no profits, and a high-risk business model that is now adding significant debt-like leverage, in the form of preferred stock, to buy a volatile asset that just dipped below $100,000. The shorts are betting that this 12% dividend will act as a cash bleed that the company cannot sustain, and that any prolonged weakness in Bitcoin's price will trigger a crisis for the common shareholders. They are betting this complex piece of financial engineering is a house of cards that will collapse under its own weight. But there is a powerful counter-narrative, which is what makes this stock so fascinating. The bulls and the company's management team, led by CEO Matt Cole, see this very same move as a stroke of genius. They argue they are using this $160 million in capital to acquire a hard asset, Bitcoin, that they believe is fundamentally superior to cash. By issuing preferred stock, they protected the ASST common shareholders from dilution. Their slice of the 7,525 Bitcoin treasury just got mathematically larger on a per-share basis. The bulls believe the 12% dividend cost is a small price to pay for acquiring 1,567 more Bitcoin. They are not just buying an asset, they are making a strategic move to become one of the largest corporate holders of Bitcoin, and they are doing it in a way that aims to amplify the upside for common stock. This is also drawing in some very serious institutional players. Filings show names like Millennium Management, Hudson Bay Capital, and notably, the crypto-native fund Pantera Capital as large shareholders. Pantera's involvement in particular lends significant credibility to the crypto side of the strategy. So, how can you as an investor track this battle? This high short interest creates an incredibly volatile situation. You need to be watching short interest data, which you can find on platforms like Fintel or directly from NASDAQ. The key metric to watch now will be days to cover, which tells you how many days of average trading volume it would take for all the shorts to buy back their shares. With a 38.58% short interest, any significant positive news, say Bitcoin rips back towards $110,000, or Strive's asset management arm reports a surprise profit, could ignite a violent short squeeze. This is where shorts are forced to buy back their shares to cover their position, which sends the stock price flying. Conversely, any sign of weakness, a missed dividend payment on SATA, or Bitcoin breaking below a key support level, could prove the shorts right and cause a sharp drop. What's your take on this 38.58% short interest? Is this smart money identifying a major risk, or is it a setup for an epic squeeze? The retail chatter on this stock is, as you can imagine, deafening. The company's recent merger with asset entities and the involvement of high-profile figures like Vivek Ramaswamy have put it on the map. The debate on platforms like X and Reddit is fiercely divided. You have one camp calling it the next MicroStrategy, a company that will use clever financing to become a Bitcoin whale and see its stock price multiply. The other camp calls it a ticking time bomb, a disaster waiting to happen, built on leverage and hubris. This is the core of the expectation versus reality framework for ASST. The expectation is that you are buying a small-cap asset manager. The reality is that you are taking a position in one of the most aggressive, leveraged, and polarizing public bets on the future of Bitcoin. Looking forward, the path for ASST is entirely dependent on a few key catalysts. The first, second, and third most important factor is the price of Bitcoin. This stock will likely move as a leveraged multiple of Bitcoin's daily swings. The second factor is the health of the core asset management business. Can it grow its $2 billion in AUM fast enough to generate profits that can help service the $19.2 million dividend on the SATA shares? If it can, that would de-risk the entire thesis. The primary risk is the opposite, a crypto bear market. If Bitcoin enters a prolonged downturn, the 12% dividend becomes a crushing weight, and the shorts will have been proven correct. Comment below with your long-term price target for Bitcoin. Do you see it hitting $150,000 by this time next year? So, as we head toward the opening bell, that 1.44 pre-market price and the 2.7% drop are not just noise. It is the sound of a very complex market trying to price in this new aggressive reality. Strive's management just made a $160 million bet. They are all in on their Bitcoin amplification strategy. The market, with its 38.58% short interest, is showing profound skepticism. This is no longer a simple stock.